So I wanted to hop on and give a quick update about the meta position we opened back in to an adjustment I made on the meta position we opened because this is a learning experience. So meta, this is the original position we opened was a bull call spread. It was a 660, 670 bull call spread, which we paid around $5 or $5.50 for the potential to make $3.50, to make $4.50, sorry, above 670. And Meta, Facebook at the time this was a couple weeks ago. Meta was trading up here. So we went for a June 660, 670 bull call spread. And since then, as you can see, Meta has gone down another $70. So I made an adjustment and I just wanted to hop on and explain the adjustment that I made and what it means. So what I did is I rolled the 670 bull call spread down to a $600 spread, to a $600 leg. And instead of having a $10 width of the spread, so 667, 670, I went with a $20 width. And then what I had to do, and if you remember, so we paid originally $5.50 for this position. And then I raised it to a $20 spread. So the max gain is now $20. And I had to pay another, this is the fill price. I had to pay another $7. So all in, we're all in the net cost. It's $5.50 plus $7. So it's $12.50 for the potential to make up to, so the full value of the spread will be 20. So it's 20 minus 12.5. So it's the potential to make $7.50. And then 7.5 divided by 7.5 divided by 12.5, that's still a 60% return. So it's not quite an 100% return, but it's a 60% return. And this is a June position. And we opened the position in beginning of March, sometime around then. Beginning of March, 3rd of March. So we're talking about a 60% gain over 3 months. So the position now, like I said, that was the order. The position now is a 600 to 620 position, bull call spread. So what we did, like I said, I'll just recap. We paid another $7 to raise the spread width by $10. So we're adding $3 of potential gain, and we're paying $7 for that gain. But the beauty of it is, where previously we would make full profit with Meta was above 670. Now we just need Meta to go up to 620. So we lowered the price in which we make our max profit. So back over in our original position with Meta trading at 660, we needed it to go up to 670. Now with Meta trading at, and I did this adjustment like 2 days ago or something. Meta was trading at 600. So I rolled it to a 600, 620. So Meta just needs to go up to here and I'll make full profit. And then it's obviously easy to see that there's a higher probability that Meta will be above this value than it'll be above this value, right? It may be above both. And if it's above both, I would have made my original $44.50 profit, but this way, instead of making 4.5 profit, I'll make 7.5 profit. So I'm making more profit at with a higher probability of success, right? Because the probability of success with Meta being above 670 is lower than it is being above 620. Because obviously if it's above 670, it's above 620 as well. So in all the cases that the first position makes money, the second position makes money, the adjusted position makes money. And all the situations where Meta is between 620 and 670, the adjusted position will still make money. So what I did is I rolled the original bull call spread. I rolled the original position to a higher probability position, which will also make more money if it's successful. And then we still have 3 months for that to happen. And as you can see, just in the last day, I mean, Meta was trading at 600 when I made the adjustment, or actually maybe it was trading at 620. Maybe it might have been trading at 620. It must have been trading at, it was trading at 600 because I roll it to the money. I roll the lower leg to the money. And since then, Meta is already up $6. Not even $6. It's up $17 yesterday, although on Friday. And then the day before, actually, it went down a little bit. But either way, the point is, it can fluctuate. Meta can fluctuate anywhere between these prices, as long as sometime over the next 100 days, 97 days, Meta will close above 620, at which point we'll make the full $7.50 of profit that we would make on our $1,250 investment. So that's the adjustment. Other than that, I actually updated I updated the paper trades potential value. So now I added another $300 of potential profit to make. So now we're up at 5,800 potential profit. And then I also I updated the values of everything. And as you can see now, the Nasdaq and the S&P, the market in general overall has been doing not amazingly, let's say. So overall, the Nasdaq is down 8.3 and the S&P is down 5.8. And our portfolio is only down 2.9. So the blue is our portfolio. So as you can see, it's slowly now starting to outperform. Although, I mean, we're losing money, but we're losing less money. We lost less money than the market has lost. And then just going over these positions, we do have paper losses, but every single one of these positions, except for one, is on track to make the full original profit. So, and I'll just go over this super quickly. So Apple is trading at $213, and our short puts we sold are $200 puts. So we pocketed originally $1,000, and these short puts are now worth $2,000, which is a lot more. So we have $1,000 in paper losses, but these losses are due to Apple maybe going down a little bit since we entered the position. I don't know when we entered the position, maybe somewhere over here, maybe over here. Either way, so it has gone down a little bit, but more importantly, because the market has been doing so bad, the VIX, the internal volatility, has gone up a lot. So the VIX, if we entered this position back down here when the VIX was at, I don't know, something around 16, now the VIX is at 21, and earlier in the week it was at 24 or last week. So you lose. So the value of the options are a lot higher, but that doesn't change the fact that if Apple stays where it is, even if the VIX stays high as it is now for the next 2 years on this position will still make our full profit, which is our original $1,000 credit. So this position is still, even though it's showing $1,000 in paper losses, it is on track to make our full profit. And the same is the case for Amazon, which is we sold 185 puts and it's trading at 197. And the same thing is true for Google, which we sold 150 puts and it's trading at 167. And then Meta, we just talked about. NVIDIA as well, it's trading at 121 and we sold 100 puts. And then PayPal is the only one that's kind of like close. It's not going to make full profits if we don't adjust it. So we sold 70 puts and it's trading at $69. And that's not to say it won't go down or up. And that's not to say any of these over the next year or two until expiration won't go down or up from here. It's just saying that, well, if we had bought the market, if we had bought the S&P, if we had bought some type of ETF, if we had bought these stocks at whatever value they were when we bought them at, we would have lost the money. And in order to have made money or get back to our original value, we would need the stocks to go back up. For these stocks, for these positions, all of these except for PayPal, which we can adjust if we need to, but for all of these positions, we don't need, in order to make money, in order to make the full original profit we were going to make on these positions when we opened them, we don't need the stocks to go up from where they are. We just need time to go by. And that's the thing about stock. They can go up or down, but time will definitely go by. So all of these tracks, despite all of these positions, despite having overall $2,600 of paper losses, these are losses that are just going to disappear over time if the market stays exactly where it is. Now, I'm not saying the market is going to stay exactly where it is. It could go up, it could go down, but over the long term, so over the last 3 weeks, it's been down a lot. But if you zoom out a little bit, you can see over the long term, it does go up. And then the thing is, I don't need for it to go up. If it stays here, if it literally stays here horizontal for the next 2 years, for the next year or two, I'm still going to make my full profits. Whereas if I had bought some stocks over here or I bought an ETF, I would have, if it stays here, I would have lost money. I would need the market to go back up to here in order to make money. And again, I'm not saying the market won't go back up to here. It's possible that it will, but even if it doesn't, these strategies are still going to make money. And then just looking at this graph, just for another second, like a lot of people are saying like Trump, tariffs, whatever, who knows what's going to happen. And the truth is, no one knows what's going to happen, but the world is probably not going to end. So are we in a situation like the market has just gone down this bit? Are we in a situation where, like, similar to what happened back in August, where it's gone down a bit and now then it's going to go back up a bit and then we'll have a recovery? Or are we more in a situation, and if we zoom out a little bit more, maybe we're in a situation where the market is going to go down and then it'll go down a bit more and then it'll go down a bit more. So like no one really knows. This is a small bit down. This is a bigger bit down. This was a full year of down. Basically 2022, this is 2 years ago. This is the COVID crash. So like, again, we could be we could be in a situation similar to the COVID crash where immediately goes up. We could go to in a situation where it kind of goes down, but even this, as you can see, 2022, the market didn't go down forever. And now, yes, it could be different, right? Trump is here. Maybe there will be tariffs. Maybe the world will go into the World War III. Maybe we'll be in a situation where like somewhere over here, the market goes down actually for 3 years, which is actually crazy. Or here, the market went down for 2 years, which is something that happened and it could happen. So I'm not saying the market is going to go up or down. I'm just saying that I'm not worried. I'm just saying that you need to take a zoom out. Yes, the market has gone down 5 to 8% over the year, but who knows where it's going to go from here. And the point is, maybe it'll go up, maybe it'll go down. But the good move to do is to stay in the market, because just in case it does go up, you want to trap those gains and to use high probability positions. You want to adjust your lower, if you have any lower probability positions. So for the Meta position, there is a good chance that Meta won't recover back up to 607, right? There's a chance it's not going to go up here, back up to here in the next 3 months. So you do want to adjust positions which have a relatively low probability of success into positions which have a higher probability of success. And ideally, ones that will make more money if they're successful. So that's exactly what we did with this bull call spread. And that's also why I wanted to demonstrate how to use a bull call spread or a vertical spread or a call spread, whatever, debit call spread. They have all sorts of names. But that is part of the reason I wanted to demonstrate how to use the bull call spread strategy to make adjustments, why it's such a versatile strategy to use. Because, and again, is Meta going to go up or down? I don't know. But if it goes down more, let's say it goes down to 550, then what I'm going to do is I'm going to do the exact same thing. I'm going to roll this down from a 600, 620 spread. I'll roll it down to a 550, call it, let's say a 550 to a 580 spread. And then this adjustment right now, it's showing it'll cost $9. And then I'm paying $9 to make $10. So I'm really only giving myself a 10%. I'm only adding 10%, 10% and 11% return. But I can also adjust it down to a 550 to a 550, 560, 550, 570 position, call it. And then I can do 2 contracts of it. So here I'm adding $2,000 and I'm only paying $1,770. And again, this roll is very expensive because Meta is really high. But if Meta was trading down at 550, this roll would be a lot cheaper. So these numbers will go down. It'll be between $5 and $7.50 to roll $10 in strike. But again, we'll get to that bridge. Once we get to that bridge, we'll cross it. But the point is, for now, the position now is in a much better situation to make more money with a higher probability. So we're going to leave it at that. I updated the paper trading portfolio performance. We are now, significantly or slightly, however, by a couple of percent outperforming both the Nasdaq and the S&P. And we'll see. And we only have the potential to make $5,800. So we're not fully invested. We do want to ideally get to a situation where we can make $10,000 over the coming year on our positions. So we are still going to be doubling down, but we are totally invested. We're invested a total of just about $17,000, so 17%. We're just about 17% invested in terms of our margin requirement. So the portfolio we're now in March, so it's 3 months old. We've invested a total of $17,000, so almost a fifth of our portfolio, which is very little. And that's all. And it's also, by the way, the reason why we're outperforming the indexes, because we're invested very little. And therefore we're also going to make very little money, but we're not even going to make that little money. So right now, all of our positions are on track to make their full money. So if we do make $5,800 on our 1,000, we still made 5.8% over the year. And actually some of the positions are 2-year positions. But again, either way, we're right now on track to make 5.8%, which if the market stays where it is, which is down 5%, to make 6% or 5% on a down 5% month year, that is 10% outperformance. So it's not bad. But again, ideally, I don't want to make 5% and not 5.8%. I want to try to make 10%. And I think it's possible to do. We're just going to track what happens in the markets over the next month or two. And we'll open some more positions on some more tech stocks, hopefully, because I like tech. Um, yeah, and follow along if you're interested to get an alert, an email when I make an update to this portfolio.